Have you ever bought the stock, held it for months, and just didn't move? The conviction was there, your patience was there, your effort was there, and your skill was there, but the candle didn't grow at all. Why? Here's the real reason. You might be fighting on the battlefield where almost no one can win: consolidation. In chart, the market doesn't move, but you are moving emotionally, mentally, and financially. You give back gains, you get shaken out, stop out, sliced up, and end up right back at zero or even losses. However, the moves that actually make money, give you profits, even change your life, come from one thing: trend. When the trend hits, money flossing, direction becomes clear, and the prices doesn't just move, it carries you. And that is why pro traders don't waste time fighting chart. They wait for trends. Then they strike and get profits. They act less but earn more. Because they know in trading, timing beats blind effort. You don't win by making more trades, but by making the right ones. So today, Oasis, together with Sharp and Z, my assistant, are going to show you how pro traders thinking about trend. Ready? Let's go. Before we dive in, here's a quick recap. In the previous video, we broke down investment champion JLaw's core trading strategy, the multiple edge trading system. If you haven't learned this concept yet, click this link for the full explanation. Simply put, the multiple edge trading strategy is a system of trading around the multiple edge trading area, a price zone where different types of traders using different indicators and approaches all lined up in the same area. When you enter a trade around m.e.t.a, you're entering a market with the majority, backed by multiple edges. Naturally, that boosts your probability of winning. Through 16 years of market experience and countless rounds of verification, JLaw identified 9 categories of trading edges, and he put trend at the very top of the list, and emphasized again and again that trend is one of the most important and decisive edges of them all. So why is trend so critical? To understand the power of trend, you first need to know the most basic question in trading. Why does a stock price move? Price movement is simply the result of a constant tug of war between buyers and sellers. Our candle on the chart represents those two sides fighting for control. When buyers are stronger, price gets pushed higher. But as price rises, early buyers begin thinking, it's time to take some profits. At the same time, short-focused traders may feel the stock is becoming too expensive and start entering positions. Selling pressure builds and price pulls back. And when price drops, short sellers take profits, and non-biased traders start thinking, it's getting cheap, there might be a bounce here. Buying pressure comes in and the prices lifts again. And that is why charts show the same rhythm over and over. Price moves up, pulls back, moves up again, or drops, bounces, and drops again. This up and down rhythm is what we call a swing. The concept of a swing may seem simple, but it's one of the most essential foundations in trading. And once you understand what a swing is, you start to see that the prices never rise in a straight line and the prices never fall in a straight line. With this understanding, your mindset will shift. You don't fear of missing out when prices are high because you know a pullback will come sooner or later. You don't panic during normal and healthy pullbacks because you know they're just part of the structure. And once you understand swings, you realize that every swing comes with a certain level of volatility, and the volatility naturally brings you risk. The moment you choose to enter the market, you are choosing to face that risk. So remember, never take on more risk than you can truly endure and handle. And if at any point the risk and the volatility becomes too much for you, you can always stay away from the market and give yourself a space to calm down. Because the first lesson, trading, is not about making money. It's about how to protect yourself and stay alive in the market. Just like small wave in the ocean, each swing in the market is what we call a minor swing. When a new minor swing forms and its high is higher than the previous high, that point is called the higher high. This tells us that buyers in control and the market is saying, hey, I want to go higher. And when that swing forms a low that is higher than the previous low, that point is called the higher low. It shows that sellers push the price down, but buyers quickly step to provide support. This tells us the market is saying, I'm not willing to pull back. Conversely, when a new minor swing forms and its high is lower than the previous high, the point is a lower high. This shows the market saying, hey, I cannot move higher. And when a swing forms a low that is lower than the previous low, the point is a lower low. This tells us the sellers in control and the market is saying, I want to go lower. A single minor swing is just a short-term push and pull between buyers and sellers. But when you zoom out and see a bunch of those waves all moving in the same direction, they form a major swing. And a bunch of major swings keep forming the same direction one after another. They create one of the most important structures in the market, a trend. Major swings that keep forming higher highs and higher lows create uptrend, showing that buyers are in control. Major swings that keep forming lower highs and lower lows create a downtrend, showing that sellers in control. However, the market is not always trending. Sometimes you will notice the highs are not breaking higher and the lowers are not breaking lower, and the price is just chopping a zone. And that's what we call the consolidation or a range. It basically means that buyers and sellers are so balanced that neither side can take control. When you see this kind of price action, you know the market is saying, hey, I'm not sure where I want to go. But because the market does not trend all the time, a trend becomes important when it appears. First of all, a trend shows you the outcome of the battlefield between buyers and sellers. It tells you that who has won, where the imbalance of power is, and the direction the market wants to go. And once that imbalance is established, reversing it becomes difficult. This is because the trend is basically the market collective emotion and expectation, and behind all that is real money moving around, especially big money. Big players such as funds and institutions moving tens or even hundreds of millions. If they buy or sell everything in one shot, they push the price way too much against themselves. So whether they are getting or getting out, they have to do it slowly, in batches, over time, and that is why trends tend to keep going. A little pullback of short-term noise is not enough to kill a trend. To reverse one trend, you need something big, a policy shift, a macro change, a fundamental shock. Something strong enough to force large capital to switch direction. And just because trends tend to continue, trading with the trend naturally pushes the odds in your favor. Trading is about finding pockets of certainty in a very uncertain world. And the trend is one of the few places where the market actually gives you that kind of clarity. When trading with the trend, you're moving in the same direction as the major mulling, and your trade automatically has a structural advantage. And that is exactly why we talk so much about trends, and why trend is the very first edge in JLaw's m.e.t.a system. And we can say that for technical traders, every edge comes from one thing, an imbalance between buyers and sellers. And that imbalance is what creates trend. Knowing why trends matter is one thing. Being able to consistently identify them, align with them, and execute with precision is what separates participants from professionals. If your goal is to consistently make profits in the market, you need to trade at a professional level. Anything less simply won't cut it. That is exactly why JLaw, the two-time US investment champion, officially launched the JLawStock Academy. JLawStock Academy, it is not a one-time course. It is a continuously evolving trading program, updated as the market changes, led by the JLaw coaching team. No matter where you are starting from, the program provides a clear path from the fundamentals to professional level skills. And throughout the journey, you are not learning alone. The team is there to guide you and support you every step of the way. If you are ready to level up, click the link in the description and take the step from participant to professional. Trading with the trend is like sailing at sea. When you move with the current, everything's smooth. Get caught in a swirl, you just spin in circles. Go against the current is not only exhausting. One big wave can flip you over. Let me show you two examples. Take m.e.t.a for instance. In about 44 months, the stock just whipsaw up and down, fluctuating between 8 and 30. If you bought anywhere in that range, you probably get shaken out during one of the pullbacks, ending up with tiny gains or even losing money. But you have waited for the trend to start, buying around 13 July. Look at what happened next. By November, the price surged to 140. In just 4 months, your stock increased about 360%. Another example is WDC. You can see the same powerful trend, just in the opposite direction. From last August to February, the stock consolidated for 6 months, fluctuating with no clear direction. Whether you went long or short in that zone, the win rate was low. But once the trend started around February, the stock dropped 45% in just 2 months. So now could you see why we should trade with trends? Because we can avoid putting our money in messy, directionless environments. Instead, we focus on areas where the market is truly moving and where the returns can be generated. The trend helps you increase your win rate, take on less risk, make better returns, make money faster, reduce the opportunity cost, and your trading becomes much easier. So the next question is, how do we support the trend on the chart? There are so many ways to identify trends, but inside JLaw's m.e.t.a system, we mainly rely on the following tools. Candlesticks. Price is the most direct language of the market. Sometimes a single big candle often shows up right at the beginning of the new trend. Candlestick pattern. Some candlestick patterns, such as several days of large candles in a row or gap candle, can also tell you that either buyers or sellers are in control. Volume. Volume is key tool for confirming whether the trend is real or not. Because when volume suddenly spikes, it usually means that big players are entering or exiting the market. Trendlines. A trendline is drawn by collecting at least 2 or more swing highs or swing lows. It helps you visualize what price is actually doing. Parallel channel. A parallel channel is basically 2 lines drawn around the swing highs and swing lows, and they are more or less parallel. Price tend to bounce back and forth inside the channel, so you can see clearly the direction of the trend. If the channel tilts up, the market is trending up. If it tilts down, it's trending down. And if it's flat, the market is moving sideways. Moving average. A moving average shows you the average price over a specific period. When you plot those averages, it forms a smooth line that reveals the underlying trend. Images like the 5-day, 10-day, and 20-day shows the short-term trends. 50-day moving average give you a sense of the mid-term trend. 150-day and 200-day represent the long-term direction of the market. And when the MA is rising, you see an uptrend. When it's falling, there's a downtrend. And when it's flat, the market is likely in consolidation. Relative strength. Relative strength compares the stock's performance to the overall market. If RS keeps rising, it means the stock is outperforming the market. In other words, money is interested in that stock and may flow into it. But if RS keep falling, it means that the stock is weaker and less attractive, and money is more likely to flow out. Please note that I'm not saying whenever any of the signals appear, a trend is guaranteed to follow. In fact, when using those indicators to identify trends, the first thing to remember is that one single signal is never enough. A real trend does not appear just because you see a big candle, an upward moving average, or spike in volume. A trend reveals itself when multiple signals align at the same time. And that is also the spirit behind m.e.t.a system. We combine the multiple edges and indicators to confirm the market direction. Let's use app as an example to make this clear. From May to late September in 2024, nothing on the chart suggests a trend was forming. But after late September, multiple signals turned bullish together. A big green candle appeared with strong volume. Several more high-volume green candles followed. Higher highs and higher lows start forming. Multiple moving average start turning up. Relative strength continue rising. When all of these signals appear at the same time and reinforce each other, that is when we can confidently say an uptrend is happening. You also need to know that if your goal is to make big profits, simply knowing that there is a trend is not enough. You must be able to identify when a trend is about to start or reverse through indicators. Only by entering the early stage of a transformation can you truly catch the wave with lower risk. Let's look back at the app. Say you bought during the consolidation period, point A about 70. For the next 4 months, the stock barely moved, and it dropped back to 50 multiple times. Your money is stuck, and you would have likely been stopped out for many times. And that's what happens when you enter too early. If you bought near the end of the trend, point B around 300, the stock soon peaked at about 420, giving you only around a 40% gain. But here's the problem. Your upside was limited, but your pullback risk was much higher. The risk to reward ratio was too low. This is what happens when you enter too late. But if you enter right when the trend began, point C in late September, it would barely experience pullbacks. And even when they did happen, those pullbacks were really small. In just 2 months, your gains could have reached about more than 100%. Hold until December, your return could have reached more than 356% in just 3 months. Same stock, same trend, completely different result. Simply because the entry timing changed your return, your speed of profit, and the amount of risk you had to carry. If you want to consistently find the right entry points, you cannot rely on a shallow understanding of indicators we just mentioned, like m.e.t.a, Trendlines, RS, and so on. You need to understand the detailed logic behind them. You need to know how to use each tool under different market conditions and context. You need to combine them into a system. And that's exactly what Oasis and Chimpanzee will break down in the upcoming videos. So remember to subscribe to this channel and turn on notifications, then you will be the first to know when we release new videos. And finally, here's one more important reminder. To make profits, finding a trend is not enough. You need to find a strong trend. Strong trends and weak trends lead to completely different results. For example, from August to November, over the same 3-month period, GDC moved from 310 to 360, only about 16% of increase. But SNDK exploded from 40 to 280. That's a more than 600% increase. Strong trends like this are always driven by strong momentum. Trends show the direction, but momentum is the force that pushes direction forward. So in the next lesson, we're going to break down one of the most powerful accelerators of fast gains, momentum. See you soon!